Good day, students. You're welcome to LODS lecture series. I'll be taking you through a quick tour on ACT 314, Intermediate Accounting 2. This video is for study session 4, Deferred Tax. Do enjoy your learning as you go through this video. Introduction. The amount of tax payable in any particular period does not necessarily bear a direct relationship to the amount of profit or loss shown on the income statement. This is due to the fact that the tax law provides for the computation of taxable income for a period based on rules different from that generally accepted accounting principles followed while preparing the financial statement. In order to properly account for the tax effect of all transactions occurring within a period, a deferred tax provision is necessary. In this study session, you will learn the meaning of deferred tax, deferred income tax, and how to account for deferred tax. Learning outcome for study session 4. After studying this session, you should be able to explain the concept of deferred tax and its terminologies. You should be able to explain deferred income tax. And lastly, you should be able to understand how to account for deferred tax. Definition of deferred tax. In IAS 12, International Accounting Standard, deferred tax is the tax consequences of the future recovery or settlement of the current amount of assets or liability in the company balance sheet if it is probable that recovery or settlement of that current amount will make future tax payments larger or smaller than they would be if such recovery or settlement were to have no tax consequences. Accounting profit. Accounting profit is the net profit or loss for the period before deducting tax expense. Then taxable profit. Taxable profit is the profit or loss for a period determined in accordance with the rules established by the taxation authority upon which income taxes are payable or recoverable. Then we have tax expense. Tax expense is the aggregate amount included in determination of the net profit or loss for the period in respect of current tax and deferred tax. Then we have current tax. Current tax is the amount of income taxes payable or recoverable in respect of taxable profit or tax loss for a period. We have temporary differences. Temporary differences are differences between the current amount of an asset or liability and the balance sheet and its tax base. Temporary differences may be either taxable temporary differences or deductible temporary differences. In IAS 12, timing differences are different between taxable profit and accounted profit that originate in one period and reverse in one or more subsequent period. Then we have permanent differences. Permanent differences are differences between taxable and accounting items for a period that are not expected to reverse in subsequent period. Then lastly, we have deferred tax liability. Deferred tax liability are the amount of income taxable. Then we have deferred tax liabilities. Deferred tax liability are the amount of income taxes payable in the future period in respect of taxable temporary differences. Deferred tax assets are the amount of income taxes recoverable in future period in respect of deductible temporary differences, carry forward of unused tax losses, and the carry forward of unused tax credits. And lastly, we have tax base. Tax base of an asset or liability is the amount attributed to that asset or liability for tax purposes. These are the definition of terms as far as IAS 12 is concerned. Taxable temporary differences. So we have for asset and we have for liability. For asset, for instance, if current amount is greater than tax base, taxable differences is equal to deferred tax liability. And for liabilities, if current amount is greater than tax base, we have deductible temporary differences, which is equal to deferred tax assets. Then for assets too, if current amount is less than tax base, deductible temporary differences is equal to deferred tax assets. And for liability, if carrying amount is less than tax base, we have taxable temporary differences, which is equal to deferred tax liability. Example: Simple has estimated its income tax liability for the year ended 31st December 2013 at 180,000 naira. In the previous year, the income tax liability has been estimated as 150,000 naira. Required: calculate the tax charge that will be shown in the statement of profit and loss for the year ended 31 December 2013 if the amount that was actually agreed and settled with the tax authority in respect of 2012 was 165,000 naira, then 140,000 naira. If you look at the question, you discover that in the previous year, the income tax liability has been estimated as 150,000. If that is the case, the amount that was actually agreed and settled with the tax authority in respect of 2012 year was 165,000. That is under provision. If the income tax liability for 31 December 2013 is 180,000 naira. For the second one of 140,000, we have over provision of 140,000 naira. So now let's look at the solution. You prepare the statement of profit or loss charge. Under provision, the year-end estimate is 180,000, and the liability agreed to is 165,000, and the liability income for the tax charge is 150,000. So we have under provision of 50,000, that is 165,000 less 150,000. We have under provision of 50,000, making a total of 195,000 for under provision in the year 2004. For over provision, the statement of profit or loss charge is this. Year-end estimate is still 180,000 naira, and we are making 140,000. That is under provision, which is 150,000 less 140,000 to arrive at 10,000 naira. So making, if you have over provision, you have to deduct it from the year-end estimate. But for the under provision, we have to add it to the year-end estimate. In this case now, for the over provision, the year-end estimate is 180,000, and we have over provision of 10,000 naira, making 170,000 if 10,000 naira is deducted from 180,000. Deferred tax accounting. Deferred tax accounting seeks to equalize the tax expense determined by the tax law, which often bear no direct relation with revenue earned. The objective is to recognize the appropriate tax expense or income related to the items recognized in the financial statement. Most deferred tax liabilities and deferred tax assets arise where income or expense is included in accounting profit in one period, but is included in the taxable profit in a different period. For example, cost of intangible assets capitalized and are being amortized in the income statement, but deductible in full for tax purposes when incurred. Recognition of the deferred tax. An enterprise should account for the tax consequences of transaction and other events in the same way that it accounts for transaction and other events themselves. Thus, for transactions and other events recognized in the income statement, any related tax effects are also recognized in the income statement. For transactions and other events recognized directly in equity, any related tax effects are also recognized directly in equity. In IAS 12, International Accounting Standard Revised, requires that the deferred tax assets shall be recognized when it is probable that taxable profit will be available against which the deferred tax asset can be utilized. Where an enterprise has a history of tax losses, an enterprise recognizes a deferred tax asset only to the extent that the enterprise has sufficient taxable temporary differences or there is convincing other evidence that sufficient taxable profit will be available. Method of computing deferred tax. In providing for deferred tax, there are three major bases. These are nil provision basis, partial provision basis, and full provision basis. The only basis allowed by SAS and IFRS is the full provision basis. Thus, method of computing deferred tax are, we have deferred method and liability method. Under this method, that is deferred method, deferred taxes are determined on the basis of the prevailing tax rate when the timing differences originate. No adjustments are made later to recognize subsequent changes in tax rate. Reversal of the tax effect of timing differences are accounted for using the tax rate current at the time the difference arise. This method is not permitted by SAS, IAS, and IFRS. Liability method. Liability method is the method in which the amount of deferred tax is computed using the tax rate expected to be enforced during the period in which the timing differences refers. Usually, the current tax rate is used as a reasonable estimate of the future tax rate, unless changes in the tax rate are known in advance. As a result, the deferred tax provision represents the best estimate of the amount which will be payable or recoverable when the relevant timing differences reverse. This is the method required by SAS and IFRS, that is liability method. Deferred taxes should be computed using the liability method. Only the temporary differences that are expected to be reversed during the period allowed by the tax law should be considered in computing deferred tax for the treatment either as an asset or as a charge to the deferred tax account. Full provision should be made for deferred taxes, that is full basis provision. Steps or approach to calculate deferred tax. The following are the steps taken to calculate deferred tax. 1. Determine the carrying value. 2. Computing income tax or income current tax. Then 3. Determine the tax base. 4. Calculate temporary difference. Then 5. Identify exceptions. 6. Review deductibility of difference. 7. Apply relevant tax rate. 8. Recognize deferred tax. And lastly, presentation and conclusion. We have come to the end of this study session. Hope to see you next class for study session 5. Thank you for listening. Bye.